Energy today in the red on the month, oil down almost 6% this month. And our next guest says he sees prices moving even lower and that, of course, China is a key factor. John Kilduff, again, Capital's founding partner and a CNBC contributor, joins us this morning. John, good to see you.
Good to be with you, Carl. Thank you.
It continues to be this incredible barbell between the geopolitics of the Middle East and deteriorating demand, especially with the focus on China. Is the Chinese part the heavier weight?
Well, it is to the extent that the Middle East situation stays somewhat quiescent. I will tell you that, I mean, you can certainly give a parade of horribles, potential parade of horribles here with what's going on with Israel, Gaza, Iran, and then the entire region. The worst case scenario there, argues for triple-digit oil prices, pretty easily. But the reality on the ground keeps being that the various sides, at least Iran anyway, they remains in check, remains unable or unwilling to take meaningful action against Israel and spark something big. So absent that, the economic outlook is such, particularly in China, that oil prices are under pressure, particularly as more and more OPEC plus countries try to sort of squeeze out some extra barrels here and there, which is keeping the market on the margin fairly well supplied.
Meantime, you've got RBOB futures here implying very tame gas prices going into September at least. Big piece in the Journal today about nat gas production starting to crack as you can't get very much above $2. I would wonder, what does scare you on the hawkish side, if anything?
Really, it's just the Middle East situation, Carl, because that could go really, really bad and would be really, really unfortunate. I don't want to make light of it at all. But beyond that, look, we do have a very active hurricane season still ahead of us. If any storms were to spill into the Gulf of Mexico, given those high temperatures, those sea surface temperatures, any storm that goes in there is going to blow up into a monster, could materially affect the refining sector there along the Gulf Coast. So that's the other big worry here for this market. But again, the sky just hasn't fallen. I don't think it's going to fall, and we should be okay all around. Even our production position relative to offshore versus onshore these days is much different profile than it was 15 or 20 years ago. We're not as vulnerable to Gulf of Mexico outages. We are still, however, extremely vulnerable to storm damage, flooding damages, and power outages along our refining breadbasket along the Gulf Coast. So that's the big wild card, but that's the only one.
So inclement weather, Middle East tensions, how do you think that changes the rhetoric from OPEC this fall?
That's going to be interesting because I expect there to be quite a bit of infighting. The plan right now still is to have a slight production raise into the end of the year, into the beginning of the Northern Hemisphere winter, which is actually the global peak demand period. But if we get WTI prices below 70, which I expect and down towards 65, that's going to engender a response. And this market of ours is great at drawing OPEC plus into doing something, into reacting, into punishing them with low prices and working against, what they really want, which is much higher prices. So that deal will probably end up being extended, not terminated, and we'll see OPEC plus trying to constrain supply even deeper into 2025 than they might otherwise have hoped.